The money you see in your bank account does not truly exist, at least not in a physical sense. This is not a metaphor, and it is not some fringe conspiracy theory. If every customer decided to walk into their bank tomorrow and withdraw their money at the same time, the entire system would collapse within hours. Why? Because the cash simply is not there. This is not a mistake. It is not a technical failure. It is the way the system was deliberately designed. This structure is known as fractional banking, and it quietly powers global debt, inflation, and the illusion of financial security. Once you understand how it works, you begin to realize something unsettling. Modern money is built on promises that can never all be honored at the same time. To understand how this began, we have to go back to a world before digital balances and numbers glowing on a screen. In medieval Europe, wealth was tangible. Gold, silver coins, jewels, physical goods. That was money. But carrying large amounts of gold was dangerous. So people began storing their valuables with goldsmiths, craftsmen who already owned secure vaults. In return, the goldsmith issued a written receipt, a simple note stating that the bearer could reclaim their gold at any time. At first, this changed nothing. Then people noticed something. Instead of retrieving the gold, they could simply trade the receipt itself. The paper represented the value just as well, and it was far easier to carry. Trust replaced metal, and that is where the system quietly changed. The goldsmiths made an observation. Almost no one came to collect their gold at the same time. Out of 100 depositors, maybe 1 or 2 would appear on any given day. The rest of the gold never moved. Seeing this, the goldsmiths took a calculated risk. They began issuing more receipts than the gold they actually held. If they possessed 1,000 coins, they might issue 2,000 claims. The extra receipts were lent out, earning interest on wealth that did not exist. As long as confidence remained intact, no one noticed the imbalance. Money had effectively been created from nothing. This practice did not remain small, and it did not remain hidden. It became the foundation of banking itself. The moment people accepted claims as equivalent to real assets, money creation was no longer limited by physical reality. By the 17th century, governments embraced this model. The Bank of England, founded in 1694, was created to finance state debt, especially war. It lent funds far beyond its reserves, and that debt was repaid through taxation of ordinary people. The burden shifted from kings to citizens. The same pattern appeared in the United States. Early banks issued notes backed by gold, then quietly issued more notes than they could ever redeem. When confidence broke, bank runs followed. Depositors rushed to withdraw their money, only to discover it was never fully there. Banks collapsed, economies froze, and yet, the system survived. Instead of abandoning the model, governments reinforced it, creating central banks to preserve public trust. The message was clear. Even if the money does not exist, belief must. Over time, this system stopped being an exception and became the norm. What began as a simple solution to a practical problem slowly reshaped the meaning of money itself. Gold no longer needed to move. Coins no longer needed to change hands. What mattered was belief. As long as people trusted the paper and trusted the institution behind it, the system held. But trust has a unique property. It works quietly when everything is stable, and disappears suddenly when doubt appears. And once money became dependent on confidence rather than substance, the rules changed. Because from that moment on, banks were no longer just storing wealth. They were creating it. This shift changed everything. Once banks realized that most deposits were never withdrawn, a simple question emerged. What if the same money could be promised to more than one person at the same time? Not physically moved, not duplicated in gold, but duplicated in records, on paper. This is where banking stopped being passive and became active. Loans were no longer issued only from existing wealth, but from expectations, from probability, from the assumption that not everyone would ask for their money back at once, and as long as that assumption held, the system appeared stable. Now, let's bring this story into the modern world. Because what you've just heard is not ancient history. It is happening right now. Imagine you walk into a bank and deposit $100. You believe that money is sitting there, waiting for you. But in reality, only a fraction of it is kept. The rest is lent out. That loan becomes someone else's deposit, which is then partially lent again, and again. Through this cycle, your original money multiplies into far more currency moving through the economy. But there is a catch. Only a small portion ever existed as real cash. The rest is debt. And today, the system goes even further. In the United States, banks are no longer required to hold reserves against deposits at all. Since 2020, the reserve requirement is effectively zero. So what stops banks from lending forever? Not vault cash. The real leash today is capital and liquidity rules, written under global frameworks known as the Basel Regulations. Banks now create loans first, and deposits come after. When you take out a mortgage, no stack of money is moved. New money is typed into existence. Only afterward does the bank check whether it has enough capital to absorb potential losses. That is why more than 90% of the money in circulation today is not created by central banks. It is created by private banks the moment you sign a loan. And this design has consequences. The first is inflation. As credit expands, the value of each unit of currency slowly erodes. Prices rise, not just because of supply and demand, but because the money itself is diluted. The second consequence is perpetual debt. Because money enters the system as a loan, there is always more debt than money available to repay it. Interest guarantees imbalance. Someone must always borrow more, refinance, or fail. The third consequence is power. Banks earn interest on money they created from nothing. Governments rely on this system to fund spending without immediate taxation, and asset holders benefit as inflation pushes prices higher, while wages struggle to keep up. When confidence cracks, the illusion breaks. The Great Depression proved it. The crisis of 2008 revealed it again. Each time, the response was the same: massive intervention to restore belief. Because without trust, this system cannot survive. And here is the uncomfortable truth. A world without debt would collapse the money supply. If everyone paid off what they owed, the system would seize. Participation is not optional. You are both the fuel and the collateral. So the lesson is not fear, it is awareness. Money is not wealth. Real wealth exists outside digital promises, skills, assets, resources, independence. Inflation is not a flaw, it is a feature. History does not repeat, but it echoes. From goldsmiths to bank runs to modern crises, the structure remains the same. A system built on belief, expanding promises, and the hope that confidence never breaks. The game continues. But once you understand the rules, you are no longer playing blind.